Hello everyone, welcome to this edition of Know Your Manager. My name is Nitin Shanbhag. I head investment products for Motilal Oswal Private Wealth, and it's a pleasure to have with me today Mr. Anup Maheshwari, Chief Investment Officer at IIFL Asset Management. Anup is a veteran of the equity markets. He has over 27 years of experience. He's been with IIFL Asset Management for the last 4 years, prior to which he spent nearly 20 years with DSP BlackRock Asset Management. Anup is also an alumnus of IIM Lucknow. It's a pleasure having you with us, Anup.
Thank you, Nitin.
While we'll get to know your strategy and your investment framework, let's start with the global markets, because CY22 was an extremely volatile year for various asset classes, including equities. It all started with the crisis in Ukraine, followed by supply chain disruptions. You had escalating commodity prices, and eventually you had the US Fed, which has started hiking rates at the fastest pace ever seen in history. And all of this has led to a downgrade in terms of equity market valuations. How do you see equity markets behaving in CY23 and beyond?
Sure, Nitin. So, in a way, a lot of those elements are still around. I mean, we've turned the year, but, the events are still with us. And, the geopolitical tensions still exist. You still have a situation where, the US Fed is slightly on the hawkish side. So we do enter the new year with some of those same challenges playing through. But the good thing is, eventually these things do play through in markets. Markets move a little ahead of time. And the way we see things is, while we normally try and avoid hazarding guesses on short-term periods of time like a year, but the fact remains that there will be new challenges that we can't think about today that will keep occurring during the course of the year. So it's difficult to exactly triangulate where the year could end. But on some of the points that we discussed, I think it's now pretty established that the US will go through a recession, but our belief is that it will be a short recession. And there's an interesting thought that we frankly subscribe to, which is that you will probably go through a situation where, having built up huge amounts of debt in government balance sheets, the only way to address it over time is to actually inflate it away. And to inflate it away, you need a few ingredients. You need GDP growth coming back. You need inflation to be slightly on the higher side, so that nominal growth is a higher number. And that actually might end up being supportive post this period where the US goes through a quick recession. You may actually see a bit of a rebound, which would be induced by pushing credit into the system. So, in the longer term, we'd have to, as always, continue to be positive. But I think from a global standpoint, a lot of damage occurred last year, and we're not necessarily seeing the same extent of damage this year from a global standpoint, assuming clearly that markets have moved ahead, and incrementally, as we go through that recession, beyond that, things probably will improve. As far as India is concerned, we've obviously navigated last year a lot better. India seems to have been on a very different cycle compared to the rest of the world. And a lot of the global headwinds actually played out to be tailwinds for India. That's not to say we don't have our own challenges, and businesses have experienced lots of challenges, particularly in terms of volatility of raw materials, etc. But Indian balance sheets generally held out well last year. Coming into this year, we continue to see credit growth picking up at a fairly decent pace, but debt equity levels are also beginning to rise. The first quarter of the year isn't great from an earnings standpoint. As we progress towards the year, we'll have to see how the earnings outlook emerges. But by and large, I think when the financial services sector is in a good shape, which it is today, it does give us some confidence that we wouldn't really expect a major downdraft in the markets. So I think a good outcome would be a decent consolidation, maybe a slight upward trend over the course of the year. And that should allow valuations to perhaps settle to a more reasonable point from a long-term investment standpoint. So it continues to be a year where we have to just do more of the same, which is focus on bottom-up stock selection. I don't think we can take any dramatic calls on the market direction this year.
Right. You mentioned the finance sector. Now, banking has been a very important sector. Obviously, it carries the largest weight in the index. And we've seen a large turnaround, as you also described it, cleanup of balance sheets, hardly any NPAs on the books. And most of these banks are extremely well capitalized to fund the next cycle. Apart from the banking sector, which are the other sectors that you think could really drive earnings growth going forward in India?
Sure. So, if you actually had to decipher where earnings has come from, it's pretty interesting. So if I go back just 2 years, March 2020, when COVID hit us, our earnings to GDP had hit a 15-year low at 2.2% of GDP. In the next 2 years, by March 22, we moved up to 4.2% of GDP. It's a 2% swing in profitability. Now, if you look at the components of that swing, 80% of that move from 2.2 to 4.2 came from 4 sectors, the top 4 sectors. The first has been metals, the second is oil and gas, the third is banking, and the fourth is telecom. Now, metals and oil and gas themselves, out of this 2%, accounted for about close to 1.2% of this total move. And that is obviously volatile, very unpredictable. We have no idea where metal prices may go. But by and large, the way it's looking now with China opening up, the general consensus is that metal prices will remain reasonably steady. Oil and gas is again anybody's guess. There's a lot of volatility in earnings there. But the residual part of earnings came from financial services and telecom, which we believe will continue. These are the 2 steady parts of earnings that will progress well. So the way we see things is from moving from 2.2 to 4.2% of GDP as earnings, we will probably now grow at obviously a more modest pace. We're looking at earnings growing at about 12% in the coming year. And hopefully it'll be a little more broader based. So sectors like FMCG, which have actually gone through a 3-year consolidation, I think we're hoping that towards the second half of this year, we'll see a better rural outcome, which may support growth there. The industrial cycle remains strong. I think CapEx continues to pick up, so I think companies in that space will continue to do well. There's a lot of positivity around manufactured exports that is likely to continue. So a lot of the economy sensitive names are still sort of improving in terms of their outlook. And financials, of course, that we've already mentioned. So I think these are some things that we can sort of see as areas that hold some promise from a portfolio point of view.
Are there any sectors that you would avoid in the current cycle?
Yeah, we never say never to anything, but again, the preference generally is to avoid areas where earnings are at peak and valuations are at peak, or where the sensitivity to any change in earnings can be fairly strong. So that could apply to a whole bunch of areas. But we're just trying to be careful of taking exposure to businesses that have those characteristics.
Right. You mentioned valuations, and that has been another talking point amongst most investors. Where do you see India in terms of valuations? And obviously the earnings growth over the last couple of years have provided decent enough cushion, but can these valuations sustain over a period of time?
Sure. So when we look at valuations, we try and simplify it. We don't overcomplicate it. We find that as a rule of thumb, price to book seems to be the sort of valuation metric that gives us a much better perspective on when the markets are overvalued and undervalued. It's more relevant than price to earnings, because earnings can be very volatile, whereas price to book is nothing but market cap to net worth, and net worth tends to be a lot more stable. If you look at India over the last 22 years, the average price to book has been about 3.1 times, and one standard deviation above is about 3.8, one standard deviation below is about 2.4. Today, where we're sitting is at 3.3 odd, is where we are on a price to book basis. So we're slightly above average for sure, but we're not necessarily at the one standard deviation above level. Normally, as it gets close to one standard deviation above, that's where one has to be very careful. The risk reward is clearly not in favor of the investor. And those are the points where you want to rethink your asset allocation call. But in between, we don't try and take too much of market calls, because obviously you rather focus on bottom-up stock selection than trying to get every little correction or move right. But right now we're at 3.3 times odd price to book, which is slightly above average. But again, if all it takes is 6 months of consolidation, and we'll be back to average, because the book value itself will grow. So it's not hugely overvalued. But to put another context to it, relative to the rest of the world, India is expensive. In fact, India is beyond one standard deviation expensive, because the other markets have fallen so much. We are probably one of the very few, if any, markets in the world which is trading above long-term average. Everybody else is pretty much below. So it is interesting, I think, while we are cognizant of our own valuations, and from a long-term point of view, we're in a okay zone. On a relative standpoint, we'll have to see how the year pans out. So India relative to other markets could be it'll be a more interesting thing to watch out for.
Right.
But on a standalone basis, from an India perspective, we remain reasonably optimistic from a long-term point of view. Some consolidation, I think, will be good for markets.
Noted. Coming to your framework, you adopt a very interesting framework called SCDV, and this takes into account both PAT growth as well as ROE, typically at 15% or above. Can you guide our investors in terms of how does this actually work across market cycles, and how does it help you filter down to a very good portfolio?
Sure. So let me just maybe explain the point for the viewers in terms of what these two things are. So, when you look at any business and you want to value a business, I think the most important thing to first understand is what is the return on net worth of that business, which is of the capital put into the business, how much return are you earning on that capital? That's the only reason why everybody runs a business, to earn a return on it. And the higher the return you're generating, the more valuable is your business. So return on equity or return on net worth is nothing but the profits to the total net worth. And that's a very important variable to track when you're deciding to value a business. The other important thing is the rate of profit growth itself. As profits grow every year, the faster the profit growth, the better it is. So normally what we've seen is if return on equity is moving up and profit growth is moving up, it's very rare that a company will not get rewarded by the market. And vice versa. If they're moving down, then the companies will tend to derate. So using those two parameters, we've created this framework. So you can just imagine return on equity on x-axis and profit growth on a y-axis. And just imagine that broke, at 15%, two lines are drawn. 15% return on equity and 15% profit is what we call the midpoint of all of this. That's the long-term economics of doing business in India. If you look at an average company in the Sensex over the last 40 years, the median return on equity is around 13 to 14% or 15%, and median profits is also in that range. Now what we do is you've got 15% return on equity, 15% profit growth. Now what we look at is there are four quadrants around this. There are businesses that we call secular. So in our SCDV, the first S is secular businesses. These are businesses that have generated north of 15%, higher than 15% return on equity and higher than 15% profit growth fairly consistently over the last 10 years, in at least 6 out of the last 10 years. So we call them secular. There's something in those businesses that is allowing them to grow faster and therefore create better shareholder value. So within secular, you have a whole bunch of areas like autos, consumer discretionary, a lot of financials there, private sector financials, retail, insurance. So very consumer-oriented businesses have
Right.
shown secular tendencies. So that's one part of the market. And at an index level, it probably has around a 20-25% weight. The other side, which is businesses that have not been able to generate 15% return on equity or 15% profit growth, are what we call value traps. So these are businesses that, periodically will do well. They'll just get very cheap and bounce. But the longer you tend to hold them, they don't tend to create as much shareholder value because they don't have those underlying economic ingredients to do it. So what comes under value traps? A lot of the smaller public sector banks have proven to be value traps. Oil and gas as a sector, to some extent telecom, and some of the utilities as well. So oil and gas, this value trap segment is about 30% of the market, and secular, as is mentioned, is between 20 to 25%. Then you have the third quadrant, which is the Ds or defensives. These are businesses that have more than 15% return on equity, but less than 15% profit growth. And that would include areas like consumer staples, FMCG, healthcare, IT services, media. And the opposite of that, in a way, are what we call cyclicals. These are businesses that have lesser than 15% return on equity because they're more capital intensive, but they can be north of 15% profit growth when we are in a positive economic cycle. And cyclicals, as the name suggests, are all the economy sensitive businesses like capital goods and metals and infrastructure and areas like that. Now, so these are the four, if you had to break the market, there are these four types of business with different economic characteristics. Now, generally in a portfolio, you want businesses that are improving in return on equity, improving in earnings growth. And the way we normally manage our portfolios is you try and have a good amount of positions in secular businesses. In value traps, you tend to be a little underweight relative to the index. You're not zero because there will be value traps that will move up and emerge beyond this economics. And between defensives and cyclicals, you have to be a bit tactical depending on what economic condition you're in. In a poor economy, low growth, people tend to prefer defensives. A lot of money flows towards defensives because they have certainty of earnings. And invariably, they get mispriced on the way up. They get overpriced. And then when the economy turns and you have a reverse cycle, then the cyclicals show higher return on equity and profit growth, and then the money moves from defensives to cyclicals, and then cyclicals tend to outperform a lot. So we've seen that these economic cycles keep happening. There'll be periods where cyclicals do well, defensives do well. That keeps oscillating. But longer term, the seculars have outperformed everything. And value traps have underperformed everything. So normally when we construct our portfolio, we try and keep these four quadrants in mind and position ourselves accordingly, more towards the secular, less towards value traps. And between defensives and cyclicals, we sort of we look at the environment that we're in, what valuations we have to pay, etc. So that's the, in a long answer, the framework that we follow.
Very, very interesting. Now, using this framework, you've actually curated a strategy which is called the IIFL Equity Opportunity Fund. And this looks at bottom-up kind of opportunities which have the potential to re-rate and also the potential to go in line with business cycles along with certain special situations that are built in. How do you bring these two together?
Yeah. So what's really fascinating within about our markets is that you will always at all points in time have good businesses going through an awkward phase, right? It's very natural. And what we're trying to capture in this framework, actually we're trying to go one step even before this framework and identify companies which are in a lower quadrant that can move up in terms of a higher return on equity, a higher profit growth phase that will help them re-rate as well as grow in terms of the underlying growth. So what we're trying to do in the Equity Opportunities Fund is look for businesses that have inherently an ability to demonstrate 15% plus ROE. They've shown it in the past.
Right.
But for some reason or the other, maybe they're in a very heavy investment cycle, or something short run has got disrupted, maybe a supply chain problem or whatever it is. For some reason, today they're below that threshold. Now, what we've seen, why, this is the way markets work, is that when, let's say in one particular year, the return on equity falls below a certain level, the market makes the assumption that that lower return on equity is the perpetual return on equity of that business.
True.
And it tends to push down the valuation or the value of that business. But at some point, if it comes back to its normal, that presents a big re-rating opportunity. So that's what we're looking for. These type of situations where a company is operating below its normal profitability, therefore the market is mispricing it, and we have the ability to capture that turnaround or the opportunity of a re-rating. So that's one part, which is business cycle related. And then there's a part on what we call special situations, because those also keep happening. So you have demergers, you have the odd acquisition or a merger, you have a management change. Management change has been one of the biggest catalysts for changes in business and re-ratings. So we keep a very close eye on these factors and try and spot opportunities in that we can take advantage of before eventually these businesses get re-rated. So it's a combination of these two. Plus we've kept a little bit of a provision for a pre-IPO type of situation. If we come across a really good idea that we believe has a very good risk reward, then we could keep that provision as well. So that's really what we're trying to do.
So the core of the portfolio really would be the business cycle plays.
Yes.
Well, at the periphery, you would have some of these special situations or pre-IPO opportunities.
That's right.
Can you give us a few examples of what you would have observed in the past from both business cycles as well as special situations?
Sure. I mean, there are many examples to give. I'll maybe just give you one of each. So let's say on the business cycle side. So one sort of example we've been giving is SRF, which is today well known as a specialty chemicals player. So SRF had gone through a phase. So SRF is a very interesting business. It's a diversified business. It is into specialty chemicals, refrigerants, technical textiles, and polyfilm. Now, the history of SRF was such that there was a period where they were investing heavily in building a specialty chemicals business. It didn't exist until 2004-05, and they were investing heavily into that business. And the market was not giving them any value for all those investments that were being made because it wasn't showing through in profits. And SRF, at that point was trading below book value, or at book value, and return on equity was fairly low because there was so much of money stuck in these projects. But as these projects started becoming operational, and as specialty chemicals started becoming a larger part of the business, we've seen a big re-rating cycle coming through. Now, this was visible at all points, but until the return on equity was not visible, the market did not reward it. But if you were slightly ahead of that curve, you would realize that they were going to go through a business cycle that had to be positive in their favor, considering the investments they made into it. So that's just one example. On the special situations side, one example I could sort of quote you is, let's say a company like, let's say Britannia, for instance. So Britannia used to be, it's always been an interesting consumer company. But the big delta happened in Britannia when Varun Berry joined from Pepsi. He changed the whole strategy of Britannia. They started manufacturing more of their product rather than outsource it. They increased their distribution network dramatically. And there was a big turnaround. Pre-Varun Berry coming in, Britannia's margins used to be 4-5% at an EBITDA level. Post his coming in, it became double digit. And a lot of it was management change related. Same company, same bunch of people, just a CEO change, and the whole business transformed and then went through a massive re-rating. So we keep looking for those type of interesting special situations as well as business cycles.
So would it be fair to say that a lot of these opportunities would be far more bottom-up rather than top-down sector-wise?
Absolutely. It has to be bottom-up. And so when we're constructing this portfolio, we have no idea, frankly, of what is the weight of this sector in the index or anything. We're literally looking at companies. We're looking at ROE inflection points. Ideally looking at companies where return on equities are moving from around single digit or 10% to 15% again. Those are periods where businesses tend to re-rate a lot.
Right.
And just build them up and hold them. So that's the idea. And then you have to be patient and wait for it to play
Very
out.
true. Very true. So it's going to be very sector agnostic, benchmark agnostic. How many stocks do you propose to have in a portfolio like this?
So again, it's really a function of how many opportunities come our way. But currently, we'd be operating in terms of the way we've thought through the portfolio with around 40 odd positions.
Right.
Yeah.
Right.
But where it, normally we would ideally like 30, but this might have a bit more simply because we find a lot of these opportunities also in the mid cap and small cap space, and therefore from a liquidity standpoint, it just lengthens the number of positions you have. But typically half of the portfolio would be large cap and half would be mid and small cap.
Right. You're also bringing this fund on the AIF platform. Now, for the benefit of our clients, why do you think this is the best platform as against anything else that might be available?
Yeah, so there are a few advantages, at least from our point of view, in terms of putting it on an AIF platform. One is the money, the capital that investors entrust to us. We have clear sight on that capital. There are no major inflows, outflows, so it just allows us to take better bets and positions on these companies. Because as I mentioned, some of them will be in the small mid cap range, which could be a little less liquid. So it just allows that. It's much easier. From an investor standpoint, I think the benefits are the fact that one can also stagger investments into an AIF format. So you can sort of build it or do a lump sum, whichever way it gives you flexibility. The second is, I guess from a tax point of view, the taxation is taken care at the fund level. So it's not taxed in the individual. And we have the ability to do these pre-IPO type situations, which you can't do in a normal fund.
Right.
So I think these things probably work in favor, and therefore it's interesting.
So it's been a very interesting conversation. I'd just like to end with what Warren Buffett typically says, that, and you touched upon it, that temperament in the market is far, far more important than intellect, right?
Sure.